Why are mortgage rates so much higher than base rate? Mortgage rates are typically higher than the base rate because as the base rate increases, banks incur higher borrowing costs, leading them to pass on these expenses to borrowers through elevated mortgage rates. Mortgage rates are influenced by various factors, with the base rate playing a crucial role. The base rate, set by central banks like the Bank of England or the Federal Reserve, represents the interest rate at which commercial banks can borrow money. When the base rate rises, it becomes more expensive for banks to obtain funds. Consequently, banks may adjust their lending rates, including mortgage rates, to cover the increased borrowing costs and maintain profitability. In addition to the base rate, several other elements contribute to mortgage rates being higher. Lenders consider the risk associated with mortgage loans, inflation rates, and the overall economic environment. If lenders anticipate economic uncertainties or higher inflation, they may factor in these risks when setting mortgage rates. Therefore, mortgage rates not only reflect the cost of funds for banks but also incorporate broader economic considerations. What is the difference between base rate and interest rate? The base rate, also known as the bank rate or base interest rate, is the interest rate at which central banks lend money to commercial banks. On the other hand, the interest rate encompasses a broader spectrum, referring to the cost of borrowing money for various financial products, including mortgages, personal loans, and credit cards. In essence, the base rate serves as a benchmark for interest rates across the financial system. When central banks adjust the base rate, it has a cascading effect on the interest rates charged by commercial banks. Understanding this difference is crucial for consumers as it highlights the interplay between central bank policies and the rates they encounter when seeking loans or utilizing credit. Why is my mortgage rate higher than the interest rate? Your mortgage rate is typically higher than the interest rate due to the inclusion of additional costs in the annual percentage rate, APR, while the interest rate represents the cost of borrowing the principal amount. The APR provides a comprehensive view by factoring in all associated borrowing costs. These costs may encompass closing fees, broker charges, points, and other expenses incurred during the loan acquisition process. Essentially, the APR reflects the true cost of the mortgage, giving borrowers a more accurate picture of the financial commitment. Therefore, even if the interest rate seems relatively low, the APR provides a more holistic assessment, ensuring borrowers are aware of the complete financial implications associated with their mortgage. Are mortgage rates always above base rate? Yes, mortgage rates are generally higher than the base rate. The base rate, determined by central banks, serves as a foundational interest rate for the financial system. However, mortgage rates, influenced by various factors such as market conditions, economic outlook, and lender considerations, tend to be significantly above the base rate. While central banks, like the Bank of England, set the base rate to influence overall economic conditions, mortgage rates are determined by individual lenders. Lenders factor in the base rate along with other elements like their operating costs, risk assessments, and profit margins when establishing mortgage rates. As a result, mortgage rates consistently surpass the base rate, reflecting the intricate dynamics of the lending and borrowing landscape.